We all have investment biases. Today I'm going to cover the top 5 that may be preventing you from reaching your financial goals. Hi, I'm Karl Eggerss. Welcome back. I've been advising people on their finances for almost 25 years. And throughout that time, I've seen all different types of situations. And a lot of times it's people get in their own way because of their preconceived notions. And so today I'm going to cover the top 5 biases that I think you may be suffering from and that may be preventing you from reaching your financial goals. Now, there's many different biases. There's probably over 30 or 40 of them. And I didn't invent these, but I did pick out the top 5 that I've seen that are the most impactful to people's overall financial health and wealth. Number 1, cognitive bias. This is essentially, what are your beliefs? What type of environment did you grow up in? Did you grow up in a really conservative family that only used money markets and CDs, that thinks the stock market is very risky, as opposed to looking at the data that shows that the stock market may be one of the best investments over the long term of our lifetime? Or did you grow up in a gambler mentality? Maybe you had a father or mother that liked to gamble, and so you're very aggressive when it comes to your investments. And that's your belief system. You believe that you have to be doing things very aggressively in order to make any money. So don't suffer from cognitive bias. That is a big one. Number 2 is confirmation bias. This is an example of if you believe that the stock market is going to go down over the next 6 months or a year, we tend to look for articles or YouTube videos or podcasts that confirm our beliefs. We want other people on our side. It's that herd mentality. And so when they receive that type of information that says the stock market's going to get down, it validates what their belief is. So it's a confirmation bias. The third one is recency bias. A great example of recency bias was the dot-com bubble back in 2000. The stock market fell about 50%. And then during the financial crisis, 7 years later, it fell another 50%. Well, guess what? When 2014 rolled around, a lot of people believed the stock market was going to fall 50% because it had just done that in the previous 7-year cycles. And they were suffering from recency bias. They were looking at something that recently happened and projecting it out into the future, as opposed to looking at 100-year history, for example. Home bias, that's the fourth one. The most classic example of home bias is an American will tend to have only U.S. stocks in their portfolio and U.S. investments because that's where they live. A European may suffer from the exact opposite. They may only invest in European stocks and bonds because that's where they live and that's their frame of reference. Another example of home bias could be in your company's stock. Because you work there, you see it every day, you may own a lot of the company in your portfolio, too much. The last one is action bias. Action bias is feeling the need to always be doing something in order for your portfolio to grow. That is your belief. You think you have to be doing something. And this is really prominent during volatile times in the stock market. So when the markets are volatile, we tend to want to do something. We need to stop the bleeding. We need to sell or we need to buy. We have to do something. And over the long term, we know the most positive results tend to come from when we don't do anything and when we sit there and just let compounding take effect over the long term. As I mentioned before, there are a tremendous amount of biases out there. These are my top 5. Any one of these can be detrimental to your financial health and wealth. Thanks for joining me.